Since the day we started studying FAR, I've been talking again and again about your 5 financial statements. We've been talking about number 1, balance sheet. We talked about income statement, statement of comprehensive income. In FAR 5, we discussed about the statement of changes in stockholders' equity, how these numbers have changed from the beginning of the year to the end of the year. And now in this section, we're going to talk about the statement of cash flows, where we're looking at the cash and cash equivalent number right here. And we'll talk about how these numbers, how cash has changed from the beginning of the year to the end of the year. So let's see, cash at the beginning of the year or end of last year was $50,000 and now it's $160,000. How has it increased from 50 to 160? So in the statement of cash flows, we'll identify the sources and uses of cash. So from where has the cash come into the entity? And what did the entity do with the cash? So that is your statement of cash flows. And we're going to divide all the sources and uses into 3 categories. We're going to look at number 1, operating activities, number 2, investing activities, and number 3, financing activities. So let me put that all here and we'll discuss all this in detail. So we got the statement of cash flows and we're looking at number 1, operating activities. Then we would have investing activities. And we'll also have financing activities. Now, operating activities, that sounds like operations. So I'll give you a general thumb rule for you to understand how your cash flow relates to your balance sheet and your income statement. Now, it's not a watertight compartment, but it really helps you a lot of times. Whenever we are looking at items on the income statement, and that's for most of the items, not all. Most of the items on the income statement and on the current side of your balance sheet, current assets and current liabilities, most of such items go into operating activities. When I'm looking at the non-current side of your balance sheet, most of the items here go into investing activities. When I'm looking at non-current liabilities and equity, most of this is financing. So guys, now you know how to relate your statement of cash flows with your balance sheet income statement. These are not watertight, these are not rules, but these are good tips for you to understand the relation out here. So let's talk in detail. When we're looking at operating activities, we are looking at how has the cash come in and gone out on account of operations, business activities. So let's say we've sold goods, but we haven't yet collected the cash. Will it come on your statement of cash flows? No, not yet. We haven't seen the money. So we're going to have sales on your statement of cash flows only when cash is collected from your receivables. That's a source of cash. So we're going to look at cash collected on sales. Now let's say we've received some advances from our debtors, from our customers. Is that sales on your income statement yet? No. But is that a source on your statement of cash flows? Yes, it is. So guys, here we were looking at the accrual basis of accounting. Here we are more towards the cash basis of accounting. We're not concerned about whether we've earned it or not. We're concerned about have we touched the money, have we seen it, source of cash. Now let's move down on our income statement. So we look at sales. Let's talk about COGS, cost of goods sold. So that's purchases. Now, you might have purchased goods from your vendors, not yet paid them the cash. So it's an expense here, but is it a cash outflow here? Not yet. It's a cash outflow only when you make payments to your vendors. So you could have payments for purchases. So when you're purchasing goods from your vendors, that's a payment. You could have payments for selling expenses. You might have incurred it. That's an expense. But here we're concerned about whether have you paid it out. Again, general and administrative, it's an expense on your income statement the moment you incur it. But here, it's an outflow only when cash goes out. So, G&A. Now moving down, so we've covered sales, got COGS, selling, G&A. Non-operating items. So what's non-operating income? When you receive interest, when you receive dividends, that's your non-operating income. So even that is part of your operations because you had surplus cash from your operations, you invested it out, investing activities, and then you made interest, you made dividends. So the interest received and dividend received, that goes in operating activities here. So I'm looking at interest received or dividend received. What's non-operating expense? A major one, interest expense. So that's a cash outflow, guys. Interest received, dividend received, cash inflow. Interest paid, cash outflow, uses of cash. O&T, taxes you paid out, cash outflow, uses of cash. So guys, as you can understand, we've been looking at all the items on the income statement. A lot of this are related to your current assets and current liabilities. Your sales, that's related to accounts receivable here. Your purchases, that's related to accounts payable and inventory. You have selling G&A, again, that could be payables. You have interest received, dividend received, interest paid. So you could have accrual accounts. So let's say interest incurred, not yet paid out. That's a liability here. So tax incurred, not yet paid out, that's a liability here. Paid in advance could be an asset. So generally, we're looking at this, the top portion of your balance sheet. Now let's move on and talk about the next one, investing activities. Now, investment is something that you can make in others. If you find them attractive, invest in them. Or if you love yourself, invest in yourself. So all that is investing activities. So guys, how do you invest in others? By buying their stock, by buying their bonds. So that's how you invest in others. Maybe by giving them loans. So guys, when you're making loans to others, when you're investing in others, making investments, could be in stocks, in bonds. That's all investing activities. How can you invest in yourself? By buying equipment, by buying property, plant, by buying intangible assets. So all that is investment in yourself. Love yourself, investing activities. So PP&E, intangibles. So guys, understand here, investing in others, when you give out loans to others, that's a cash outflow. But when you collect back those loans, that's a cash inflow from investing. When you invest in stocks and bonds of others, that's a cash outflow from investing activities. But when you sell those investments, when you sell those stocks and bonds, that's a cash inflow again from investing activities. When you go out, shop for your PP&E, buy your PP&E, that's a cash outflow. You got to pay them out. But when you sell your PP&E, that's a cash inflow, cash comes in. So we're looking at cash outflows and inflows from investing activities due to these items. Now, one thing that you need to remember is if you have a gain or loss on sale of investments, if you have a gain or loss on sale of PP&E, that doesn't go on operating activities, that comes in investing activities. So guys, if you had a gain on sale of PP&E, that would be non-operating income here. But that is not operating activities, that comes in investing activities. So let me show you the journal entries. So let's say you went out, you shopped for PP&E, you bought PP&E worth $100,000. So you had PP&E debit 100 and cash went out 100. So is this cash inflow or cash outflow? Guys, cash has gone out. This is a cash outflow from investing activities. This is a cash outflow. Now, let's say you've used this equipment for a lot of years and 7 years, let's say, and the current book value of this equipment is $30. and now you sell it for $40, gain of 10. So guys, cash coming in now, and this is cash inflow. You've sold this for, let's say, 40, but the book value was only 30. So that means PP&E would be credited 100 and there would be accumulated depreciation of 70. Because I'm sure you remember this from FAR-3. Now, you have a gain on sale, which is 10. So guys, the book value of the PP&E that you sold was 30. And you had a gain on sale of 10. Now, all the cash that you got in from the sale of this PP&E is a cash inflow from investing. Now, this naturally includes the gain on the sale. If you had a loss on sale, so let's say if you sold it for 25 bucks, sold it for 25 bucks, that means you have a loss of 5. What's your cash inflow? Book value was 30 minus 5 of loss. Net, what came in cash inflow? 25. So this 25 is the number which would go in the cash inflow from investing. So all the gain or loss on the sale of PP&E, that's not operating, that's part of investing. Now let's look at investments. So let's say you've bought investment, marketable security. So you've made investments to cash. Let's say you made investment for 100. Is this a cash inflow or a cash outflow? Cash has gone out, cash outflow. It's a use of cash. Now, let's say you sold this investment for $125,000. So now cash came in. How much cash came in? 125. Investments, there was 100, and there's a gain on sale of investment 25. Now, when you purchased, when you made an investment, all this 100 cash outflow was part of your investing activities. When you sold off this investment, all the 125, so this includes the 100 which was the purchase price of the investment and 25 gain. So all this 125 is part of investing activities. So guys, this is a concept that you need to be very comfortable in, and we'll talk about it again and again when we do some problems on cash flows. We've talked about operating activities, where generally our focus was on the income statement and on the current side of a balance sheet. We've talked about investing activities, where our focus generally was on this non-current side of the balance sheet. We looked at investments, we looked at PP&E, intangibles. Now let's talk about financing activities, the finances of our business, the guys who have paid us to start our business, to run our business. So how do you get money? You either borrow money or you have your owners inject capital. So that would be loans taken or loans borrowed. You could issue bonds. Now here you made out loans, you invested in others, now you're borrowing loans. Here you invested in somebody's bonds, now you're issuing your own bonds, bonds payable. Then we could also have equity, so our owners injecting in capital. So guys, let's compare investing versus financing. When I'm making loans, giving loans to others, when I give the loan, it's a cash outflow. When the other party clears off the loan, that is a cash inflow from investing. But now, to run my business, when I borrow a loan from somebody, that's a cash inflow from financing. When I clear it off, that's a cash outflow from financing. Investments. When I make investments in somebody else, that's a cash outflow from investing. When I sell off the investment, that's a cash inflow from investing. When I issue my own bonds, in that case, it's a cash inflow from financing. When I retire my bonds, when I pay them off at maturity, that's a cash outflow from financing. When I bought my PP&E intangibles, that was a cash outflow from investing. When I sold them off, cash inflow. Similarly, equity. When the owners inject in capital, when we issue new stock, that's a cash inflow from financing. let's say when we go out to the market, buy back our own stock, treasury stock, that's a cash outflow from financing. So guys, you got to be comfortable about cash coming in, going out. Cash coming in, it's a cash inflow, sources of cash. Cash going out, it's a cash outflow, uses of cash. Now, one thing that you need to note here. So I said interest received, dividend received on these investments, that's operating. When I said interest paid on these bonds, that's operating. Now, when you have dividends paid out to your equity stockholders, dividends paid out, can you expense it on your income statement? No, it's not an expense. It's a distribution to owners. That reduces the retained earnings out here. So dividends paid out, that becomes financing activities. That's not operating. So dividend received is operating. Dividends paid out, that's financing. So guys, we've looked at operating activities, investing activities, financing activities. Now, during the year, we could have net cash used by operating activities or net cash provided by operating activities. You could have net cash used or provided by investing and financing activities. Then you sum total all these three changes. You look at the total change in cash. Then you look at what was the cash at the beginning of the year. That gives you your cash at the end of the year. So let me quickly look at an example that you have on your book. So this one has net cash flows from operating activities, and this number is 470. So we had a positive cash flow here, cash coming in from operations, $470. It seems we made a lot of investments this year. Cash went out due to investing activities, $750. So cash, there was a net cash inflow from operating activities, basically net cash provided by operating activities, 470. Net cash outflow from all these investing activities, 750. That means cash used by investing activities. Then we also raised some money this year, so there was a net cash provided by financing activities. That means the net cash inflow from financing, and that was 390. Now guys, if I sum total all these three, it comes to net cash inflow of 110. So I could say the net increase or decrease in cash. So net increase or decrease in cash, that's 110. Now to this, if I look at the cash at the beginning of the year plus beginning cash balance, and let's say at the beginning of the year we had a $50,000 of cash. What's the net cash at the end of the year, or the ending cash balance? So guys, look at it. The statement of cash flows has provided us all the information about how cash has increased or decreased during the year, whether due to operating or investing or financing activities. So that was $110,000 for this year. Then we added the beginning cash balance, $50,000, and we got to the ending cash balance number, $160,000. Now guys, look at how the statement ties into your balance sheet. Here you have this number, $50,000. That was the cash at the beginning of the year or end of last year. So that's your number 50. The last number, ending cash balance, $160,000. That's the cash and cash equivalents at the end of current year, $160,000. Change, 110. And that's what we've been talking about here. So guys, we're looking at operating, investing and financing activities. We're looking at the statement of cash flows on page 44. The statement of cash flows is a required financial statement whenever a company is presenting the results of its operations for a year. Put a box around required financial statement. On the third bullet there, you got three categories of activities in the statement of cash flows. First one, highlight operating activities. And this includes collections on sales from customers, cash payments for purchases and for SG&A. The tricky ones here, highlight interest received, highlight dividend received, and highlight interest paid. So even these are operating activities. Now, operating activities also include acquisition and disposal of trading securities, payments for income taxes. Next one, highlight investing activities. Now, this is principal collections or loans made by the entity. So, when you make a loan, that's a cash outflow from investing. When you collect, it's a cash inflow from investing. Acquisition or disposal of available for sale or held to maturity investments. Again, when you make an investment, it's a cash outflow from investing. When you dispose the investment, that's a cash inflow from investing. Next one, acquisition or disposal of PP&E and intangibles. So, make an investment, cash outflow. Dispose it, cash inflow. Now, for investments in PP&E, draw arrows and write includes any gain or loss on sale. Now, for further understanding, I've put in journal entries here. So, let's say we are acquiring PP&E. The debit is PP&E, the credit is highlight cash and write outflow. Now, when you dispose of PP&E, the debit, highlight cash and write inflow. And then you close off the accumulated depreciation account, PP&E becomes credit, and look at that, the gain on sale of PP&E. So that is again cash coming in. So when there's a gain on sale, there's excess cash coming in, goes into investing activities. When you have a loss on sale, there's less cash coming in, which again goes into investing activities. So investing activities include any gain or loss on sale of investments or PP&E. Moving on to page 45, highlight financing activities. So these are activities which include issuing debt or equity or retiring debt or equity. Good examples include highlight bonds, highlight issuance or reacquisition of stock, and highlight dividends paid. So when you receive dividends, that was operating activities, but now when you're paying out dividends to your stockholders, that's financing. Looking at the journal entries that I've got here, so when you're raising equity or debt, it's highlight cash and write inflow. When you reacquire treasury stock or retire debt, on the credit, highlight cash and write outflow. Now, the second half of this page, you got a pro forma statement of cash flows. So the first one, you got cash flows from operating activities. And after you list down all the activities, you get highlight net cash provided or used by operating activities. The number two, you got cash flows from investing activities. After you list down all the sources and uses of cash, you get highlight net cash provided or used by investing activities. Then you have cash flow from financing activities. You again list down all the sources and uses of cash from financing activities, and you get highlight net cash provided or used by financing activities. When you sum up all these three numbers, you get highlight net increase or decrease in cash. To that, you highlight add beginning cash balance, and this gives you your highlight ending cash balance. And this number is the same number as you have as cash and cash equivalents on balance sheet. So the ending cash balance number on the statement of cash flows reconciles with the cash and cash equivalents number that you have on your balance sheet. I'm pretty sure some of you guys are thinking, interest received, dividend received, that's out of investing activities. Because we invested in bonds, we got interest. Because we invested in stocks, we got dividends. So why is the interest and dividend received as part of operating activities? Now that's a rule under GAAP, but under IFRS, you may classify interest received and dividend received as either operating activities or investing activities. So that's an option which IFRS gives you, not GAAP. Now under GAAP, interest paid is operating, dividend paid is financing. Now under IFRS, interest paid or dividend paid, they may be treated as either operating or financing. So a lot of options for you under IFRS. Even looking at taxes, taxes paid under GAAP is operating. Now under IFRS, what you could do is you could allocate the investing or financing portion of the taxes paid as investing and financing activities. So guys, under GAAP, pretty much strict rules on how you're supposed to be classifying. IFRS, lot of options. On the second half of page 46, we're looking at IFRS. So highlight, IFRS allows more flexibility than GAAP in classifying cash flows related to interest, dividends, and income taxes. Now, even IFRS classifies taxes paid as operating, but allows allocation to investing or financing for portions specifically identified with investing and financing activities. Interest or dividends received under GAAP, that was operating. Under IFRS, they could be operating or investing. Now, interest paid under GAAP was operating, dividends paid was financing. Now, under IFRS, interest or dividends paid, these could be operating or financing. Now, the statement of cash flows out here, this looks so much like a summary of your cash account, where you identify all the sources of cash and uses of cash, and that is called the direct method. So you're talking about how much cash came in from sales, how much cash went out to vendors for selling and G&A expenses, for interest paid, taxes paid, what was interest received, dividend received. You're looking at investing activities, how much loans did you give out, invest in others, did you buy stocks and bonds of others, did you invest in yourself, did you borrow money, finance your company, did you issue bonds, raise capital, or did you retire bonds, buy back treasury stock, did you pay dividends? So basically the summary of all your cash account, how cash came in and went out. That is called the direct method. Now you're required to use the direct method for investing and financing activities. So these activities always need to look like a summary of your cash account. But for operating activities, you've got two options. First option, present it like this. This looks like a summary of cash account. Second option, use the indirect method only for operating activities. Now in the indirect method, it's more like a reconciliation approach, where you start with the net income number on your income statement and you calculate, you make adjustments, a few adjustments to get to the net cash provided or used by operating activities. So guys, once again, for investing and financing activities, always use direct method. For operating activities, you could use direct or indirect method. On page 47, we're looking at direct or indirect method for operating activities. And this option is not there for investing or financing activities. So only direct method for investing or financing. You got an option of direct method or indirect method for the operating activities section. For the investing activities or financing activities section, it's only direct method. Highlight direct method. So here you list down all the sources and uses of cash. Now the next one, highlight indirect method, which is a reconciliation approach. Now this is allowed only for the operating activities section, where you reconcile net income with cash flow from operations. Now we'll be looking at examples of using the direct and the indirect method for operating activities. And before that, let me put on numbers that you have on the income statement on your book. So here you have sales $1,500. You got COGS 500. So this one is sales, 500 is COGS. You got selling 250. So 250 is selling. G&A is 100. Now, your depreciation expense separately for 125. Now, I told you depreciation expense, if it's for production related equipment, plant, that goes into COGS. If it's depreciation of your delivery trucks, that's selling. Depreciation of office equipment, that's G&A. But because we're looking at cash flows here, what we've done is we've taken out depreciation from all of these and put it together, 125. So this depreciation applies to G&A, to selling and to COGS. Then you have non-operating interest expense of 75. Equity in earnings of investee, 25. Remember, equity method of accounting for investments, significant influence. Non-operating, you also have $25 gain on sale of AFS. Guys, this is a realized gain on sale of available for sale securities. If it was an unrealized gain, that would have gone into accumulated OCI, the A of PACE. Now this one is a realized gain, comes to the income statement. Then you got taxes, 150. This gives us net income of $350. So guys, this is something like the income statement that you have on your book. Now what we'll do is we'll assign some bullet numbers here so that it gets easy when we're using the journal entries for our direct method. So what I would say is sales, this is number 1. I would say COGS is number 2. I would say selling number 3, G&A number 4, depreciation number 5, interest number 6, equity in earnings I'll call it 7, income tax expense I'll call it 8, and available for sale securities gain, that will be number 9. Now you also have selected balance sheet account changes during the year. So accounts receivable, it says, has increased by $200, inventory increased by 75, accounts payable, that increased by 50, allowance for uncollectibles increased by 50, accumulated depreciation increased by 125, bond discount decreased by 15, investment under equity method increased by 25, deferred tax liability, that increased by 25, taxes payable liability increased by 100. So let's get to the book, put the numberings there that I have my green pen here, and we'll come back and I'll solve it for the direct method first. On page 48, we got the numbers for the example that I've just put on the board. So on the top, you got highlight income statement, you got sales, COGS, SG&A, depreciation expense taken out separately, interest expense, equity in earnings, income tax expense, and gain on sale of available for sale security. And this one is a realized gain. Then you have highlight balance sheet. So you got selected balance sheet account changes for the year. And I've put numberings again here. So sales on the income statement, that relates to accounts receivable on the balance sheet. So I got number 1 for increase in accounts receivable. COGS on the income statement, that relates to inventory and accounts payable on the balance sheet. So I got number 2 here. Selling expense on the income statement, which includes bad debt expense, relates to the allowance for uncollectibles on the balance sheet. So I got number 3 here. The depreciation expense on the income statement, that relates to accumulated depreciation on the balance sheet. So that's number 5. Interest expense on the income statement, that relates to bond discount on the balance sheet. So you got number 6 for decrease in bond discount. The equity in earnings of investee on the income statement, that relates to the investment account on the balance sheet. So you got number 7 for the increase in investment account. The income tax expense number on the income statement, that relates to deferred taxes and taxes payable on the balance sheet. So you got number 8 for deferred tax liability and taxes payable changes. So we have identified the income statement with the changes in accounts happening on the balance sheet. Now let's get back and solve it for the direct method first. Now using this income statement, this is accrual basis, and the changes in balance sheet accounts that we have on your example, we're going to create the statement of cash flows. And now we're looking at operating activities, and we'll do it using the direct method. Now direct method, remember I told you it's like a summary of your cash account. So the way we'll solve it is we'll try to create journal entries, look at the cash plugs there, and fit it into the summary of this cash account, operating activities, direct method. So let's look at the numbers here. Let's say number one, we're looking at sales. Now sales has been $1,500 during the year, but has the entity collected all the $1,500 cash collections? For that, we look at the accounts receivable number on the balance sheet. Now they say that number has increased $200 from last year. What this means is maybe for all the sales that they've made, they haven't been able to collect all the cash. Of 1,500 sales they made, they could collect only 1,300, $200. It increased their accounts receivable here. Let's do the journal entry, look at the cash plug, which will get on to the cash flow statement. So I'm looking at the first journal entry that we're going to be having for sales, and it says sales have happened 1,500. Has all the cash come in? Let's look at accounts receivable, which increased by 200. Increased by 200 means a debit to accounts receivable for 200. That means cash came in only 1,300. Now this is what we were looking at. This is our cash plug, and this 1,300 would flow into the statement of cash flows. So let's have a debit and a credit here. So now the debit would be the 1,300 cash collected on sales, because it's increased the cash inflow. Guys, we are looking at it as a summary of the cash account. Moving on, the second item, COGS. The cost of goods sold is $500. Now that relates to the inventory number on your balance sheet. It also relates to the accounts payable, your vendors here. Now it says that inventory increased by $75. This went up by $75. That means we bought a lot of goods. We didn't use all that, or we didn't sell all that, but we bought more than what we sold. Accounts payable also increased by $50. What that means is we took extended credit from our suppliers, or whatever, liabilities increased. Now let's make it very easy. Use a journal entry for all that's happening with COGS. So that's number 2. And COGS, I know that's 500. Inventory is increased by 75. Inventory, that's a debit account. Increase means debited further. Accounts payable, that's a credit account. Increase in accounts payable, credited further. So how much has the cash actually been paid to the vendors? Because I'm not looking at what's the cost of goods sold. I'm concerned about cash gone out on the cash flow statement. So what's the cash actually used? So that's 500 plus 75. 575 minus 50, 525. And this is a number which is going to flow in to my statement of cash flows. The cash plug that we have here. Payments to vendors. Look at the third one, selling expense. Now it says selling includes bad debt of 50. Now that's $250. Now it includes bad debts. So I would want to look at what's happening to the allowance for bad debts on the balance sheet. Allowance for uncollectibles bad debts, that's a contra accounts receivable. So you have accounts receivable less allowance for uncollectibles. So what's happening with that? Now it says that has increased by $50. So guys, selling expense includes my bad debt expense, and I'm concerned about what's happening to the allowance for uncollectibles account on the balance sheet. And using both these, let's create our journal entry. Now, so you have selling expense, that's 250. Allowance has increased. Now allowance is a credit account. It's increased, further credit, 50. How much has cash actually gone out? So though the selling expense is 250, it seems that the cash gone out is only 200. And that is the cash plug. Something we're concerned about when we're looking at the statement of cash flows. Now next journal entry, G&A expense, $100 here. Now There's nothing related to G&A that I could find on the balance sheet items. So I would say all this 100 G&A is paid out by cash. There's no outstanding, no excess payment, no deferral. G&A cash 100. So that's my cash plug. This is the number which flows in here. Looking at the next item, depreciation. Guys, depreciation. Does that mean any cash has gone out? Think about it. We bought a PP&E few years back. We paid out cash, that was cash outflow from investing. Now, as we're using it, we're depreciating it. Are we giving out cash every year? No, we gave it when we bought it, investing activities. Now we're just using it. So depreciation, this is a non-cash expense. So for depreciation, your journal entry is depreciation debit and accumulated depreciation credit. And that number here is 125. Do you have any cash out here? No cash. So nothing comes to the statement of cash flows under the direct method. Next one, we're looking at interest expense. Now, interest expense is $75. Now, that would relate to the bond discount that we have on the balance sheet. Now, it says there's a decrease in bond discount of $15. Maybe we had bonds payable out here and there was an amortization of bond discount for 15. So guys, let's do the journal entries. So we're saying interest expense, that's 75. Has all of that gone out in cash? There has been a decrease in bond discount. Bond discount, that was a debit account. Decrease means you've credited it, it's got amortized. So bond discount amortization. So 75 has been the interest expense, of which $15 has been bond discount amortization and only 60 has gone out in cash. So cash plug here is 60. So the interest paid, that is 60. Now looking at the next journal entry, you've number 7, equity in earnings of investee. That's 25. And that relates to the investment under the equity method. Even that has increased by 25. So guys, under the equity method, we said whatever the investee earn, our portion of the investee's stake, whatever they're earning, we're going to recognize it on our income statement right today. Because even if they're not giving us back as dividends, we have significant influence to go back later and collect it. But for the cash flow statement, we are only looking at how much have the dividends been received. Now here, the earnings from the investee equity in earnings is 25. And the investment on the asset side, investment in the investee account, that has also increased by 25. What that means is it seems that the investee paid out no dividends. Look at the journal entries here. The investment account increased by 25. So this is the investment under the equity method. This increased by 25, and the credit equity in earnings also increased by 25. So there's no cash plug here, so no impact on your statement of cash flows. Next one, number 8, we're looking at tax. Now income tax expense on the income statement, that's 150. Now that relates to two of the balance sheet accounts that we've identified. It relates to the deferred tax liability. It says the deferred tax liability, that's decreased 25. And it also relates to taxes payable, which have increased by 100. So let's put all the changes there on the journal entry. So I'm looking at the 8th journal entry here. This is income tax expense number out here, that's 150. Now, deferred tax liability has decreased by 25. Deferred tax liability was a credit number. Decrease means debit. So DTL 25. Income tax payable has increased. That's a liability. An increase in liability means for the credited 100. So how much has the cash actually gone out? The income tax expense here, that's 150. But how much has the cash gone out? Because that's what I'm concerned about. Taxes paid, not incurred, paid. 150 plus 25, that's 175 minus 100 gives me 75. So that's the cash plug that I'm looking at from this journal entry, which flows in here. Now, looking at the ninth one, gain on sale of available for sale securities. Now guys, gain on sale, I told you that would come under investing activities. So when we are buying investments, making investments, so that is a cash outflow. So cash outflow, we buy the investments. When we sell those investments and make gains, that's a cash inflow. So all the cash inflow that comes in, that might include gains and losses as well, goes into cash flow from investing activities. There's no impact on operating activities. In the operating activities, we're just looking at interest and dividends received from those investments, not the gain on sale of those investments. So I'll not do this journal entry at all, because right now we're just looking at the direct method for operating activities. So now, putting the numbers together, you got 1300, 525, 200, 100, 60, 75, all good. So this one is 1300. So all the cash inflow from operating activities, $1,300. Cash outflow, that's 960. What's the change? The change is $340. So then source of operating activities, cash inflow 1300. Cash outflow 960. Net increase in cash or net cash provided by operating activities, or the next net cash inflow from operating, $340. This is the direct method. Now let's go to the book, look at the direct method journal entries, and we'll come back and I'll do the same problem using the indirect method. On page 49, we're looking at direct method, past journal entries, and look at the cash plug. So looking at the first journal entry, sales was $1,500, but accounts receivable increased by $200. So the cash collections on sales, that was $1,300. So highlight cash, and that's your plug. Second journal entry, COGS was $500, but inventory increased by $75 and accounts payable increased by $50. So the cash plug was $525. So highlight cash on the credit. Third journal entry, you got payments for selling expenses. Selling expense on the income statement, that was $250. But allowance for uncollectible on the balance sheet, even that increased by $50. So the cash outflow from selling expense, that was $200. So highlight cash, and that's your plug here. The fourth journal entry, G&A expense, we could not find any balance sheet related account here. So G&A expense debit 100 and credit, highlight cash. So all the cash went out was 100. Fifth journal entry, you got depreciation expense. Now that does not impact your cash account. Your journal entry is depreciation expense debit and the credit is accumulated depreciation. For the sixth journal entry, interest expense on the income statement, that was $75. But we had an amortization of bond discount in the balance sheet for $15. So the cash that went out towards this interest expense is $60. So highlight cash, and that's your plug number here. The seventh journal entry, we're looking at equity in earnings. Now we saw that the equity in earnings number on the income statement, that was $25. But the investment number on the balance sheet, even that increased by $25. So you could say that all the earnings of the investee was recognized as equity in earnings and there was no dividend received. So no cash inflow there. So look at the journal entry. Investment increased by 25. Equity in earnings, that was credit 25. No cash inflow during the period. Next, we're looking at income tax expense. So the number on your income statement is 150. But you saw that deferred tax liability decreased by 25, so debit 25. Income tax payable increased by 100, so credit of 100. And your net cash plug is $75. So on the credit there, highlight cash, and that's your plug number here. Turning on to page 50, we got gain on sale of investment. Now the cash proceeds from the sale of available for sale investment, that's a highlight investing activity. So the gain is a non-operating gain and not part of operating activities. So on the journal entries, you're going to having a cash inflow from the sale of investment and the gain on the sale. But that cash inflow is from investing activities. And right now in this section, we're just looking at operating activities. So look at the summary there, operating activities under the direct method. If cash collected from customers, $1,300. You got payments for purchases, for selling expenses, for G&A, for interest and taxes. And this gives you, highlight net cash provided by operating activities. And highlight $340. Now as we know, the operating activity section, this can be presented either under the direct method as we've done here, summary of the cash account, or the indirect method, which is a reconciliation approach. What you do there is you start from this net income number and then you make adjustments. We'll talk about 3 adjustments which help you get to this net cash flow from operating activities. So let's get started. So we have the direct method here. On the other side of the board, I'm going to do the indirect method. Again, we're looking at the statement of cash flows. And looking at the operating activities section. So the first number here is going to be the net income from the income statement. On the income statement, we have $350 net income. So that's your first number out here. Net income. Ideally, what we say here is, we think that all the income earned, most of it should be in cash. Let's say all the sales were in cash, all the purchases were in cash. So net income could reflect the change in cash from operating activities. So we'll start from that and we'll make adjustments for all that didn't happen in cash. So net income for the year, that's $350. Now, when we're looking at the calculations of net income, we have a few non-cash items here. So that's our first adjustment. So looking at this, what are the non-cash items that we can identify? Sales less COGS, that's cash. Selling is cash. G&A is cash, goes out in cash. Do you pay out depreciation in cash? No, you don't. So that's a non-cash item. So that's an adjustment 1 on your indirect method. Interest, that again goes out in cash. Equity in earnings, is it earned in cash? No, we get dividends in cash. Equity in earnings, that's all the investee has earned, even if they haven't paid out the dividends. So this one is a non-cash item, our adjustment number 1. Gain on sale of available for sale. So when you're selling available for sale, you're getting all the cash. So that's a cash item. Tax again is a cash item. So adjustment number 1, identify the non-cash items. Adjustment number 2, identify the non-operating items. What doesn't go on the operating activity section? So the gain on sale or available for sale securities here, that goes in investing, not operating. So that's a second adjustment. So if you have a gain or loss on sale of PP&E, that again goes in investing. That's not operating. So we're going to identify all that. What we'll do is all these items, now we'll take it out of net income. So guys, we'll start with net income and we'll make an adjustment. We will say this depreciation, the cash didn't go out. So we're going to add back 125 to 350. So this was a subtract here. We're going to add it back. Looking at equity in earnings, we didn't get that in cash. So we're going to subtract it from here. When I'm looking at gain on sale of available for sale securities, that's going to go in investing activities, and that's an add here. So we're going to subtract it down here. So let's do both these adjustments and I'll talk about the third adjustment after that. So adjustment number 1, we are looking at depreciation expense and we are looking at equity in earnings. Depreciation expense was $125, which never happened. So you got to add it back. So it'll increase the net income here. Equity and earnings. Now we saw that the investment account also increased by $25. So ideally there was no dividends coming in. All that was earned by the investee but not paid out. But that increased the net income number. Now we need to reduce it. So if I say this is the debit, this is the credit, I'm reducing the net income number. I'm reducing it by $25. Now, next, we're looking at the second adjustment. Second adjustment is for available for sale securities gain on sale, which goes on investing. So, gain on sale of AFS. Now, this was a $25 gain, which should not come under operating activities. It will come in number 2, investing activities. So here we'll have $25 reduction of the net income. Now, let's do the T accounts, couple of T accounts for investment, equity and accumulated depreciation. Okay, we'll do that later. Now, along with that, let's go back. We have a lot of balance sheet account changes for the year. Now, when you start from a net income, this is computed on the accrual basis. Now, you need to make adjustments for those changes in accrual basis accounts. The way we'll do it is we'll try to create T accounts for all changes that are given to us, and then we'll make adjustments. So guys, this is your adjustment number 3. Come back there. So adjustment number 1, you're looking at non-cash items. Adjustment number 2, you're looking at non-operating items. Adjustment number 3, here you're looking at all the changes in the balances of accrual accounts. So we have a lot of changes in balances given to us. Let's draw all of that. So you have change in accounts receivable, and it's given that that change is $200 increase. That's a $200 debit. So there'll be a lot of stuff on the debit and the credit, but the net increase is $200 for accounts receivable. Then you have inventory. For inventory, you have net increase 75. Increase means debit for inventory. Next, you have accounts payable. So draw the T account and it's increased by 50. So increase by 50 means it'll be a credit here, 50. Increase in allowance for uncollectibles, allowance for uncollectibles. An increase in that allowance means you're going to have a credit of 50. Allowance is a credit account. Increase means credit 50. Then you have accumulated depreciation. Now that increased by $125. You have decrease in bond discount. Bond discount, that was a debit number. Decrease generally by amortization is $15 here. Then you have increase in investment under the equity method. Investment, we're looking at the equity method investment, and that increased by $25. Then you have decrease in deferred tax liability, and that was $25. Liability, that's a credit account. A decrease in liability means debit, 25. Then you have increase in taxes payable. So tax payable Payable liability, increase in liability means credit 100. So guys, now you got all these T accounts in place. So these are all the balance sheet changes that have happened during the year. Now what we'll do is we'll look at what are those T accounts that we've already considered. So I could say this depreciation expense, this is 1A. Equity in earnings, this is 1B. Depreciation expense 125. Accumulated depreciation. Now naturally, the moment you have depreciation expense, accumulated depreciation, that would increase. So this is done. Now we got the reason why it's increased. Equity in earnings, that's 25. Now we know that investment under the equity method, that's increased by 25. So naturally all the earnings that is there in equity in earnings is not collected in cash. It's earned by the investee, but cash didn't come in. So this 25 debit becomes a 25 credit here, and this is scratched off. Now this was simple and easy because these were the non-cash items. So this was 1A. Let me use a green pen for numberings. So this was 1A and this was 1B. Number 2, gain on sale of AFS. We don't have the available for sale securities account here, and we don't need it because that's investing activities. Now we are looking at all the remaining T accounts that we couldn't scratch off, and we're going to scratch them off all one by one because this one is our adjustment number 3. So on the third adjustment, we're looking at the changes in the balances of accrual accounts. So first, let's look at what's happening to our accounts receivable. Accounts receivable is increasing by $200. So we would need this $200 debit here, which would mean a $200 credit here. So the increase in accounts receivable, it's a debit on the T account, a credit here. Guys, think about it. We started with the assumption that all the net income that we've earned during the year has been earned in cash. But then we saw of all the sales that we have made, we haven't been able to collect all the cash. So of the $1,500 sales that we made, we could collect only $1,300. The $200 that we couldn't collect is that part of net income which was not earned in cash. So we need to reduce this from net income. Now, if what I just said looks to be a little complicated, forget it. Look at the T accounts. It's a debit here, needs to be a credit here. You debit that, scratch it off. So this becomes adjustment 3A. Next, you're looking at increase in inventory. Increase in inventory. Let me write. We need $75 out here. The moment we have $75, we can scratch it off and we'll put $75. Debit there means credit here. This becomes 3B. So adjustment number 3B. Using the numbering so that it gets easy for you to identify it on your book. Next, we're looking at increase in accounts payable. So you got increase. Look at my pen management out here. 4 color pens all at the same time. Increase in accounts payable, and that's $50. Now increase in accounts payable, that means we need a credit here. Now that credit would go on the debit side here. And this becomes a cross. This is 3C. Next, we're looking at the allowance for uncollectible. Allowance for uncollectible, that's increased by 50. So that means it's been credited here by 50. So here we would debit it by 50. Since a credit there, debit it here. And I would number it 3D. Yeah. Next, I'm looking at amortization of discount. This one gets scratched off. Next, I'm looking at the amortization of discount. You need a credit here. A credit here would mean a debit here. And with that, I would scratch it off. I would call it 3E. Coming back here, 3E. That is basically a decrease in bond discount or an amortization of bond discount. Next, I'm looking at decrease in the deferred tax liability. Decrease in DTL, guys. That was a debit here. So a debit here means I'll put $25 here, scratch it off. 25 debit would become 25 credit here. I'll get 25 on the credit out here. And I'll number it 3F. And finally, we got taxes payable. That's increase by $100. So increase in taxes payable. I'd call it 3G. 3G. Name sounds pretty familiar. 3G. Okay. And then this one, we need a credit here. The credit here would mean a debit here. So debit 100 here. Now with that, I'll even scratch this off. So guys, I created those T accounts. Why? Because I love scratching it. I did that in school and I loved it, and I'm doing it again here. Now, everything gone. So we've made adjustment number 1, looked at non-cash items. Adjustment number 2, we have eliminated the non-operating items. Adjustment number 3, we have adjusted T accounts for changes in accrual balances. Now, I've tried to explain you the logic. So when I showed you increase in accounts receivable, so we've earned the money, not yet collected all the cash, so less. Increase in accounts payable, we've bought the goods, we've incurred liabilities, but we haven't paid them yet, so increase in earned income. So you can understand the logic, or it's just okay to look at those T accounts. And remember, we are posting on the opposite side of the T account. So if it's $50 credit for allowance for uncollectible, that becomes a $50 debit here. If it's $100 credit for tax payable, that becomes a debit here. If it's a $75 debit for inventory, it becomes a credit here. So you've got to be comfortable with this. Now, let's look at the very important calculations. 350 plus 125 plus 50, 50, 1500. The total is 690. 25, 25, 50 to 50, 325, 350. What is 690 minus 350? The change from operating activities is 340, and it's an increase of 340. Wait a minute. Let's see what we did in the direct method. Under the direct method, where we actually had it as a summary of the cash account, we had the same number, $340. Now the result under the indirect method, that's again 340. So guys, this one is indirect method, and that was direct method. But the amazing news is that whether we used direct or indirect, we got the same result. Direct method, we presented this as a summary of a cash account. What's happening? What's cash coming in? What's cash going out? Indirect method, we started with a net income number. We started with this 350 number. Let's find it there. 350, that's the number we started with. And we got to the change in cash flow from operating activities. Whether the operating activities, they have provided cash, positive, or they've used up cash, negative. So guys, direct and indirect method. But this is only for the operating activities section. For the other two sections, investing and financing. So after operating activities here, you're going to have investing activities and you're going to have financing activities. Now, these two sections would be the same as here, no change. So investing and financing are always presented under the direct method. How much cash came in, how much cash went out. From where did the cash come in and where did the cash go? With that, you would have the net increase or decrease in cash plus beginning cash balance gives you ending cash balance. So 1, 2 and 3. Then you would have net increase or decrease in cash. You do plus beginning cash balance gives you the ending cash balance. I don't have space here, but I'm sure you smart CPAs, you understand what I'm trying to do here. What I'm trying to say is between the direct method and the indirect method, the only difference is in the operating activity section. And even for the operating activity section, the result is the same. I hope the camera can capture both the numbers, 340 here and 340 here. So we've already looked at the direct method, the way we used journal entries, use the cash plugs. Now we've looked at the indirect method where we're looking at 3 adjustments. First adjustment, non-cash items. Second adjustments, non-operating items. Third adjustment, all the T accounts, draw them, scratch them off, put in the numbers on the opposite side, and guys, you're good to go. On page 51, we are looking at indirect method where you need to close T accounts and plug to cash flow statement. And we're talking about 3 types of adjustments. So adjustment number 1 and highlight non-cash items are adjusted. So you're looking at depreciation, amortization, equity in earnings. Then you have adjustment number 2 and highlight non-operating items are adjusted. So you're looking at gain from sale of available for sale securities, held to maturity securities. You're looking at gain on sale of PP&E. Third one, adjustment number 3 and highlight changes in the balances of accrual related accounts are adjusted. So you're looking at changes in the balance sheet accounts. Now then we have a box which contains all the T accounts depicting changes in the selected balance sheet accounts during the year. Now for easy understanding, let's start putting in the dollars and the numbers. So for accounts receivable, write 3A, so that's adjustment number 3 and it's 3A as we number it here, and write $200 on the debit. Investment account, write 1B and debit it by $25. Inventory, write 3B and debit number $75. Accounts payable, write 3C and the credit number $50. Allowance for accounts receivable, write 3D and the credit number there is $50. For accumulated depreciation, which is a non-cash item, write 1A and credit number is $125. Bond discount, write 3E and the credit number $15. Deferred tax liability, write 3F, debit number $25. Taxes payable, write 3G and the credit number here is $100. So now we've looked at all the T account changes. Let's look at the operating activity section and we're looking at the indirect method here. So you start with highlight net income $350. Then we'll do all the adjustments. So depreciation expense and equity in earnings, put a bracket on the left and write adjustment number 1 equals non-cash. So first we're looking at all the non-cash items. For depreciation expense, write 1A. So you can look at the T account there, 1A. That was a credit there and hence we have a debit on the operating activity section of the cash flows. Equity in earnings, on the T account, we had debit 25 for investment. Hence we have a credit 25 here, right? 1B. Then you have the gain on sale of the available for sale security. On the left, right, adjustment number 2, non-operating. And this one is adjustment number, right, 2A. Then you have a few changes in balance sheet accounts where we're looking at accounts receivable, inventory, accounts payable, allowance for uncollectible, discount amortization, deferred tax liability, tax payable. Put a bracket around all that and write adjustment number 3, change in balances. For increase in accounts receivable, write 3A. Now 3A was debit on the T account and hence it's a credit on the cash flow statement. Increase in inventory, write 3B. Again, that was a $75 debit on the T account, hence it's a credit 75 here. Increase in accounts payable, write 3C. That was a credit on the T account, therefore it's a debit here. Increase in allowance for uncollectible, right? 3D, that was a credit on the T account, debit here. Amortization of discount, right? 3E, that was a credit on the T account, debit here. Decrease in deferred tax liability, right? 3F, that was a debit on the T account, hence a credit here. Increase in tax payable, right? 3G. So 3G was a credit on the T account and it's a debit on the operating activity section of the cash flow statement. So we started with net income. We did our adjustment number 1, adjustment number 2 and adjustment number 3. And this gives us highlight net cash provided or used by operating activities. And the net change is highlight $340. And the good news, right, same result as direct method. On page 52, I've got a narrative description of all that's happening on the indirect method for the operating activities section. So highlight begin with net income of $350 and then write adjustment number 1 equals non-cash. So looking at the non-cash items first. Then the next sub-bullet, write adjustment number 2 non-operating. And then you have write adjustment number 3 change in balances. So indirect method for the operating activities section, that's a reconciliation approach where you start with the net income number on your income statement. You have the 3 adjustments for non-cash, non-operating and change in balances. The result highlight net cash provided or used by operating activities. Now this is allowed for operating activities only. For investing and financing activities, you have to go for the direct method. So highlight for investing and financing activities, same presentation as in the direct method. So we've looked at 2 methods of presenting your statement of cash flows. Method number 1, we had the direct method for operating activities, where we had the net cash provided or used by operating activities. Then we did investing activities and financing activities. So we got net cash provided or used by investing activities, financing activities. That gave us the net cash increase or decrease during the year. Plus beginning cash balance gives us the ending cash balance, the same number as here on the balance sheet. Then we looked at method number 2, where we had the indirect method for the operating activity section. For investing and financing, it was the same numbers as we have, the same method as we have there. So you had this one as the net cash provided from operating activities using the indirect method. Though the method was different, it was more like a reconciliation approach. The result was the same. Then you had net cash provided or used by investing activities. This one you would use direct method. Financing activities, that gave you the cash increase or decrease during the year, plus beginning gives you the ending cash balance which is there on your balance sheet. So direct method for operating activities, indirect method for operating activities only. Now let's talk about supplementary disclosures. US GAAP requires that if you're doing operating activities under the direct method, you also need to present the indirect method as a supplementary disclosure, as a separate schedule. So what it means under GAAP, and this is not for IFRS, only GAAP requires that if you're doing direct for operating activities on your statement of cash flows, present the indirect as a supplementary schedule. So guys, if you're a smart CPA and you want to find time for your date on Saturday night, don't do direct. Simply do indirect and you'll be done. If you do direct, you have to do both direct as well as indirect. Now, going back to disclosures. So, number one, if direct method is used, present the indirect method for operating activities as a separate schedule. Number two, you also need to have a schedule for non-cash investing and financing activities. Guys, I said non-cash investing and financing activities because the cash investing and financing activities, they come here. So let's look at non-cash investing and financing activity. So let's say you take a loan, rather you have a note payable and you get in cash. So your journal entry for that would be cash to note payable. Then let's say you use this cash to go out and buy PP&E to cash. So cash to note payable, this cash was a financing activity. PP&E to cash. So this cash which went out, cash outflow, was an investing activity. So both these transactions, they appear on the statement of cash flows. Now how about you purchase this PP&E directly and you finance it entirely by this loan? Cash doesn't come to you. The cash directly goes to the manufacturer or the dealer of the PP&E. So in that case, your journal entry would be PP&E debit and notes payable credit or loan credit. Would this appear on the statement of cash flows? I can't see cash account here. Now this one is a non-cash investing or financing activity. Such activities are required to be disclosed separately because they don't appear here. If you're taking a loan for cash and then use the cash to buy the equipment, both of that would appear. So the loan would be financing activity. The investment in the asset equipment would be investing activity. But here it's non-cash, doesn't appear on the statement of cash flows, required separate schedule for this. More examples of such non-cash investing or financing activities, let's say, is a convertible bond, where the convertible bond holder comes back with this bond, takes his equity. No cash here, but there has been financing activities where this bond is no longer outstanding and there's equity outstanding instead. So that's a non-cash financing activity. Think about capital leases that we talked about in FAR-4. So the journal entry in case for lessee was leased asset debit. So they had an asset and a liability, a lease liability credit. So that again is a non-cash investing and financing activity. So guys, you need to disclose them because they don't appear on the cash flow statement. Now let's get there. So this was the two disclosures that you required when you're doing direct method. Number one, schedule for indirect method. Number two, non-cash investing financing activities. Now, when you're doing the indirect method, good news, then you don't need to present the direct method. But you just need to disclose the dollar amounts for interest payments and taxes payments. So when you're doing indirect method, you're good to go just with this. But you simply need to disclose these two numbers because the users would be interested in how much interest have you actually paid out, how much taxes have you actually paid out. And the second disclosure that you have when you're doing the indirect method is presenting the same schedule of non-cash investing or financing activities. So guys, when you're doing direct method, two disclosures. Number one, indirect method. Number two, non-cash investing financing activities. If you're doing indirect method, again, two disclosures. Number one, these two amounts, and number two, the schedule of non-cash investing or financing activities. Now, if the last section on EPS is still on your minds, remember, you do not need to disclose cash flows per share. We're looking at supplementary disclosures on page 53. Put a box around if direct method is used. And highlight schedule to reconcile net income to cash flow from operations is required to be presented. And this requirement is only for GAAP, not for IFRS. So right, need to do indirect method even if direct method is used. and highlight schedule is identical to indirect method, and that's why I told you you need to do the indirect method even if you've used the direct method. The second important disclosure here is highlight schedule of non-cash investing and financing activities. So right there, non-cash equals disclose as it does not appear on the cash flow statement. An example of a non-cash investing and financing activity is PP&E purchased entirely by loan. So you have PP&E debit and notes payable liability credit. So instead of being a cash inflow from financing activity, notes payable, and a cash outflow from investing activities, PP&E, is just a single journal entry where there is no cash inflow, no cash outflow. So this becomes a non-cash activity. If you had cash inflow from note payable and cash outflow for PP&E, let's put the journal entries, right? Cash debit, notes payable credit, and right, PP&E debit, cash credit. This would have appeared on the cash flow statement, but you don't have cash here. So put a cross around cash on the first journal entry and on the second journal entry. So you have PP&E financed directly and entirely by the note payable, by the loan. So you have PP&E debit and note payable credit, no cash account here, and hence it does not appear on the cash flow statement. You're required to present this on a separate schedule of non-cash investing and financing activities. Moving down on this page, put a box around if indirect method is used. Then you need to disclose, highlight cash payments for interest and income taxes. And you also need to have highlight schedule of non-cash investing and financing activities. Guys, even if you're using the indirect method for investing and financing activities, the presentation is the same as in the direct method. So you need to have the same schedule if you had any non-cash investing and financing activities.